So that's the thing about people, that if you're starting to trade, you do need to understand that there is an art to it. There is, you have to use your, I guess it's imagination. I don't know. I think if you trade long enough, you earn the right to have intuition, because intuition is your subconscious application of your experience. If you look at literally millions of charts and you're looking for just that right look, and I've heard Dave Ryan talk about that.
Right.
You know, it doesn't quite have that look. That's what you look for. And the 4-day course that I taught, there was an entire day that I dedicated to this. Okay, guys, all we're going to look at is charts that have that look. I didn't show them any crappy charts. And the idea is you got to burn what's right into your mind so deeply that then you just have this intuition that you're not going to get when you first start. The difference, the definition of intuition for an experienced trader versus a brand new trader is this: the experienced trader has a subconscious application of huge memory banks. The inexperienced trader, well, intuition's really just guessing.
Yeah. And you know what? A funny story to your point, Mike Webster, who, you know, when he was a portfolio manager for Bill O'Neill, he came up with the idea one time to create kind of a model book of faulty bases. Like, oh, here are things that didn't work. Bill said, go ahead and do it. I don't want to see it because I have trained my brain to look at all these charts that worked. I'm not interested. I'm not interested in looking at, you know, a bunch of, I'm not interested in, you know, having my brain kind of commit that to memory as much. I want to focus on the ones that work a lot more.
Did Mike ever do it? Did he keep going with it, or he just gave up on the project at that point?
Yeah, I think he's like, you know what, that makes sense.
Yeah, because it makes sense. But initially, it makes sense for Mike's point of view. Like, let me just study that stuff. But when I heard, you know, what Bill said, it's like, you just want to focus on those perfection, right? You want to focus on that.
Yeah, I learned, that's one of the things that I learned too. I learned it the hard way. But I really focus a lot these days on the psychology of trading, because you can look at all the charts. And if you see the picture perfect one, like some of the miners like Mara and Riot last year, it's like these perfect volatility squeezes, and the one explosion to the upside. It's like, I need to get more money. And then you'll see NVIDIA, stuff like that. Okay, that works. Those work really well, but those are so rare, so few and far between, that the rest of the time you're just kind of rummaging around looking for the right charts, and you're not really seeing them. And so if you're not careful, like I tell people, if you sit at your desk long enough and look at enough charts, pretty soon you're going to find something stupid to do.
It's so true. It's so
you
true.
know, yeah. Like I tell people that you want to, part of your habit has to be pushing away. Pushing away from the desk. And I read a study not too long ago where the most profitable traders over time, like the most consistently profitable traders, spent less than 4 hours in the market every day. And I think that's a good rule, because I know I got really good when I first started trading a little more actively. Like, I got really, really good at making money during the first part of the day, and even better at giving it all back during the middle part of the day. You know,
exactly. Well, Nicholas Darvis, right? The how I made money, $2 million in the stock market. He was getting charts that were like 3 days delayed and traveling the world as a ballroom dancer, right? So
that's exactly right. You know, and yeah, you don't need. I know people like the level 2 screens and all that stuff. I never found those to be useful. I mean, these days I just look at anything that's on my charts. It has to be worth something. It has to give me information, like moving average, convergence, divergence, MACD. I don't need that. That's a lagging indicator of 2 lagging indicators. Like, I mean, you could look at the price and go, well, hey, I think it's in an uptrend. And then I get a crossover. I mean, it doesn't work for me. And when I first started, I remember one of the first trading workshops I taught. I'm kind of embarrassed about it now, but I taught people how to have like RSI, stochastics, MACD, Bollinger Bands, Keltner channels. I might have even had Donchian channels in there, and the key moving averages. And it was like how to make art on a piece of paper with a bunch of different lines and squiggles. Now I use Bollinger Bands because they make sense to me. I worked for John Bollinger for a very short period of time back in, I think that was 2001, something like that. He's a really smart guy. So obviously I'm going to kind of learn Bollinger Bands. And so I use that. I use the 50 and the 200-day moving average, and I use volume. And that's all. That's all I need.
Yep.
Because all I want to do is buy low, sell high, or buy high, sell higher. I don't need to see a stochastics pop or any of that crap. All that does is distract you, and it gives you a reason to do something that you shouldn't be doing.
Yeah.
You know.
Well, and I want you to kind of come back to a point that you brought up earlier, because it's so important and something that a lot of people sometimes don't put enough time into thinking about, and that is risk management. You know, and you know, sometimes that risk management is going to differ for different people. You know, as you get older, your risk management style changes. When you're, you know, in '97, you know, $10,000, you know, hey, you know what, if you had lost it all, you had a lot of time to make that up.
Right.
So how do you kind of approach your risk management
Okay.
things?
Yeah, I focus a lot on that now, more than I ever have, which is probably why I keep more money than I ever have. But the thing is, I'll start with, is this a good entry? You know, I got to find the right stock. But the way I look at it is this: I look at it in terms of R multiples, and that's what multiple of the risk that I'm taking should I reasonably expect to be making. And so whatever price I buy at, then where is my stop? So that's the risk, that, and the number of shares. We won't talk about the dollar amount, but that's my risk. Like, let's say it's a $5 difference between where I buy the stock and where I put my stop. So I'll talk about that for a minute. So why do I have like a $5 stop there? It's not mathematics, it's not arithmetic, it's not a formula. It has to start with the entry. You have to have the entry such that if you're wrong, and you got a 50-50 chance of being wrong. Every time you buy a stock, could go this way, could go that way. You don't know that much. So you have to understand that. So where is the stock right to buy? And the way I would look at that is, okay, what level does the stock have to go down to before it hits the, oh crap, I'm wrong level, versus, oh, I'm just early. And so I need to be able to put a logical stop. In this case, it's $5, right? I need to be able to put that stop there. And then if I look at that as my risk, then if I can just make $5, that's not a very good trade, because I'm only making $5 for risking $5. Even if I make $10, that's a 2R multiple. I mean, that's better. And as long as you got a decent batting average, you know, you can do really well on 2Rs. But I look for 3Rs. Like, I want to be able to look at a chart and say, if this stock does what I've seen so many other stocks do in charts that look just like this, if it does that, I'm going to have a really, really nice trade here. And so that's really what I look for, is the, like, if I'm right, where would the stock logically go? And then as that old saying goes, is the juice worth the squeeze? You know, is the reward worth the risk? And that's why I'm much more comfortable trading stocks where they have a lot of blue sky on top. Like, they don't have what I would call built-in sellers. So that's how I manage my risk. In fact, I'm just actually done. I think we got a couple more bugs in it. I've been working on this trade tracking tool for longer and many more dollars than I want to mention. But one of the things it has on it, you put in your trades, you actually calculate them before you do. Like, let's say I want to make this trade, put in your stuff, and right there on every single flipping page is the R multiple thing.
Mhm.
So I look at that, and there have been several times when I'll put in a trade and I'll look at what the R multiple calculations are, and I'll go, no, it's
Yeah,
not,
not
no,
worth it. Mhm.
it's not going to do that,
Mhm.
so it's not worth it. But you don't have to have an app to do that. You just have to use common sense,
Mhm.
but that's how I look at it, is the probability and the likelihood of a stock moving up high enough, like maybe 3 times what you're risking.
Yeah.
That's the way I look at it.